Well, it was a strong day for the stock market as the United States awoke to news that we would be putting on some tariffs with Chinese imports. However, they would only be 10% as opposed to the previously expected 25%. So the markets kind of breathed a sigh of relief. And it was more of a risk-on type of a day here today where we saw a lot of those cyclical areas like industrials and discretionary and technology doing very well. But as always, there's a few things that we need to discuss, some flies in the ointment that we need to be aware of. So we're going to review those here tonight. We're also going to take a look at a reversion to the mean trading opportunity based off of what we saw with interest rates here today. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's September 18th, 2018. Thanks for joining us here at Market Scholars. First of all, if you are new, welcome aboard. We're grateful to have you in our audience. Make sure that you sign up for our email distribution list, which you can find in the description area over at YouTube. In addition to that, we're heavy users of Twitter. Make sure you're following me at Brandon Van Zee. And if you get value out of these Market Outlook videos, make sure you click like and retweet over there on those posts on Twitter as well. And then lastly, we do have a presence on Facebook. We would invite you to join our group there. You can see the web address kind of embedded in that Facebook logo in front of you. All right, with that, let's go ahead and dive into the analysis of the markets here. And as you can see, I've got my 4-grid pulled up. Now remember, for those of you that are Premium Market Scholars subscribers, you're welcome to follow along with me during my presentations by glancing up at the pink label in the upper left-hand corner of our various charts that we present. This one happens to be chart 4B. And remember, this one is going to be a 3-month daily candle chart on 4 different major equity indices here in the United States. We've got the S&P 500 in the upper left, the Dow Jones in the upper right, NASDAQ Composite lower left, and the Russell 2000 in the lower right. Now, as you can see, we were up across the board here today. We were up 0.54% on the S&P 500. We were up 0.71% on the Dow Jones. Remember, there's a lot of mega cap multinational companies within the Dow Jones like Caterpillar and Boeing that probably were very celebratory regarding some of the trade news that we heard here today, at least on a relative basis. Down below here, we do have the NASDAQ showing some strength today, up 0.76%, and then lastly, the Russell 2000 up 0.44%. Now, as you can see, having said that, with all of the positivity from today, we still have a little bit of loose ends to tighten up here before we're raging bulls yet again. Now remember, we haven't been raging bears for quite some time here on these videos. There are patches here or there where we might have some concerns, but largely this has been a market that's been fairly easy to navigate because trends have held. We haven't had a whole bunch of broken down support. That's where things get a little bit confusing. So fortunately for us, we've kept pretty much bullish for most of the summer months here. As you can see, with our NASDAQ Composite and our Russell 2000, we do have what's known as weekly bearish posture. It's not strongly bearish, it's weekly bearish. The reason we know that, by the way, is remember that the color scheme of these charts will turn light pink if it's weakly bearish. It'll turn dark pink if it's strongly bearish. So right now, we're at kind of a breaking point of sorts. You'll notice that both of these charts, whether you're looking at the NASDAQ or the Russell 2000, they're both hanging on by the skin of their teeth to the moving average itself. Remember, that moving average, in this case is the 30-day moving average that we use here, is oftentimes used as either a bounce area or as a magnet. Oftentimes, you'll find that stocks will just kind of ride that moving average in whatever direction it came from. Well, as you can see in both of these cases, just like most of the markets, the direction that it's coming from is from the lower left-hand corner, right? It's going from the lower left to the upper right. In other words, these are uptrending charts. So until we start seeing significant breakdowns of support, we assume that the future will be largely similar to the past. Now, obviously, that's not always going to happen. Things will come out of nowhere and you know, bust up the charts. But remember, if you're predicting that ahead of time, you're speculating, unless you have some reasoning behind it other than you just have a hunch that all of a sudden the stock market's going to break down. So right now, what we see is markets behaving themselves, going up, perhaps gently. Remember, 2017 was an amazing year where we had really strong trends across the board. So I can certainly see how some of you that might be newer to the markets are maybe a little bit disappointed with 2018, but let's recall that we are still up on the year. This has been a decent year by all accounts. And so just keep that in the back of your mind. As you can see up here, we do have green background colors for both the Dow Jones and also the S&P 500. And so that reminds us that we have bullish postures on those too. So I wouldn't necessarily say that's the breakdown that I want. Keep in mind that if you want a really robust market, oftentimes they are led by some of the more speculative areas like small cap Russell 2000 or like the tech heavy NASDAQ, but beggars can't be choosers. Right now, I would say I'm reasonably pleased with where the markets stand as somebody who is almost always going to have more exposure to the long side of the market than the short side. Remember, I'm more of a long-term investor myself, focused on dividend growth investing. So I do appreciate it when the markets are resilient, as they have been for quite some time. So as it stands right now, bullish postures on the S&P 500 and the Dow Jones, weekly bearish postures on the NASDAQ and the Russell 2000, but they're both sitting on a potential bounce area, so I wouldn't write them off quite yet. Let's go ahead and take a look at another chart setup here. Let's go over to our longer term chart now. This is our 1040 crossover method chart. And kind of what I alluded to previously was that we've largely been bullish on these videos. You know, every so often we do have a bearish posture. It happens. Remember, that's the nature of stocks that oscillate up and down. But largely we've been bullish for a long time. This chart can kind of prove that case. These are longer term charts. These are 3-year charts here. Each one of the candles is a week in length. And this is kind of our long-term setup to kind of get a sense, where is this trend? Where has it come from? And what we're doing is we're using 2 different moving averages to establish our posture. We've got a 10-period exponential moving average represented by the orange line, and we've got a 40-period exponential moving average represented by the blue line. And in all 4 of these US indices cases, we had a crossover of the orange line that went up and through the blue line over 2 years ago. You can see in the case of the Dow Jones that I'm pointing at right here, it would have been back in March of 2016. So we're talking about almost 2.5 years ago. You would have gone bullish using this particular methodology here, and you would have stayed bullish the entire time. There hasn't been a time since then on any one of these 4 charts where we've had a bearish crossover where that orange line went down below the blue line. So at this point, it's still status quo. I know it's maybe not exciting or exhilarating for some of you that like a lot of heavy action as traders, but you know, for those of you that have slow time money out there, maybe the 401k type of money, where you just want to try to be on the right side of the market more often than not for long periods of time, then this perhaps could be a way to kind of view some of those longer term decisions that you make. And right now we continue to be bullish. Let's take a peek at a few other charts here. I wanted to take a brief moment to look at the yield curve. Remember, this is going to be chart 4J. We don't usually look at this in these videos, since there's not usually a whole lot to report from that perspective. But we did have a big movement out of interest rates today. We'll talk about that here in just a little bit, but just be aware that interest rates did spike higher today. In fact, you can see that the 10-year Treasury yield is up there, just breaching that 3% level. And so keep in mind that when you're looking at this chart 4J, we've got all of these different kind of durations of these Treasury bond yields plotted on this chart. And they're all color-coded so that way you can see which ones are which. Now, as most of you are aware, when you have a normally functioning yield curve, you should see that the 30-year has a interest rate that's above the 20-year, which is above the 10-year, which is above the 5, which is above the 2, which is above the 1, and so on and so forth. So you see that structured kind of naturally over here because all of those are set up the right way. In other words, the longer the duration should be, the higher the yield. But what this bottom portion of the chart is telling you is something a little bit different. It's telling you what the difference is between the 10-year Treasury yield and the 2-year Treasury yield. Some folks will refer to that as the 2-10 spread. And what you'll notice is what we've been on a long decline here with this particular graph, and we're approaching zero. We're not there yet, but be aware that if we do approach zero and we actually touch it, that would be known as an inverted yield curve. And what that's saying is that in this particular case, the 2-year Treasury yield would be yielding more than the 10-year Treasury yield. So all of them have kind of risen as time has gone on, as you can see right here. They're all rising, they're all kind of moving higher in recent years. But what you're finding is that the short end of the yield curve is rising at a faster rate than the long end. And so eventually we could see an inversion there. And remember, a lot of times what we found is that when we do get an inverted yield curve, within the next, let's call it 2 years or so, we start seeing some serious market disruption, even possibility of a bear market ensuing in the stock market. So be aware of that. But remember, this isn't necessarily the best operating environment for banks out there. A lot of times people say, well, if interest rates are going up, banks should be, basically doing the old Scrooge McDuck backflops in their pile of money. Well, that's not exactly the environment we're in right now. This is an environment where we find that the short end is going up rapidly and the long end is only drifting higher. Now remember, if the short end is going up rapidly, that means that banks are paying higher amounts of short-term interest on all the deposits that they have, whether it's in the CDs or just some of the short-term instruments where depositors are putting their money within the bank. Where the banks are hoping to make money is on the long end when they loan that out for mortgages and other 30-year products, 10-year products, etc. So you're finding that this is not the ideal environment for profit-making potential for a lot of the banks out there. So just kind of wanted to point that out right now. Let's also have a conversation about our ratio charts. Let me see if I can find that one. That's going to be chart 4I for those of you that are following along at home. And as I mentioned in the intro, this has been largely a risk on day, but remember, one day does not necessarily make a trend. Now, as we look at a lot of these different ratio charts, a lot of them are still supportive of stocks in general. In particular, notice kind of in the middle here with these green colored ratio chart that we do have SPY versus bonds, so stocks versus bonds basically. And as you can see, this is a nice upward trending chart. What that means is that stocks are outperforming bonds. Likewise, you can see that stocks continue to be outperforming gold. However, you will notice that gold's been making a little bit of a stand here recently. We've kind of talked about that in previous market outlook videos as well. So as gold has tried to find a little bit of a bottom, you're finding that this ratio chart is starting to plateau a little bit as well. I would still say it's bullish towards stocks, but keep your eye on it. Other things that support a more risk-on environment right now, you will see that USO versus gold continues to see some upward ascent right there. That's generally perceived positively as well. But one other thing I'll point out, U.S. stocks versus foreign stocks. Notice that this has been a trend of higher highs and higher lows right here. We're at a point right now where we had a little bit of a pullback. So that means that foreign stocks have outperformed U.S. stocks for, let's say, the last week or so. But we're at a point here, kind of a natural point, where in the past where we've had those little pullbacks, almost flagging types of technical analysis patterns where you found a bounce out of U.S. stocks there. So keep your eyes on that. But really why I wanted to kind of talk about this particular ratio charts here today is in the lower right-hand corner. Notice that small caps versus mega caps is maybe showing us something other than risk on. And remember, there's always going to be things that you can poke holes into. There's rarely a perfect environment for stocks out there. So this would be one of the holes that bears could poke in the thesis of the bulls right now, which is small caps have been laggards versus the mega caps, at least over the last 3 months. What you see here with this chart that largely starts in the upper left and ends in the lower right means that mega cap stocks are outperforming small caps, or if you want to think about it the opposite way, small caps are underperforming mega caps. So in other words, this area of the market that is typically more of a risk-on area, an area that can be a little bit more easily pushed around and manipulated. Small cap stocks, usually if there's animal spirits in the marketplace, small cap stocks is where you seek out that type of performance. You're not seeing that in the current marketplace. And remember, that could be partially due to some of the interest rate environment and different things like that out there as well. But again, keep your eye on that because we did hit 3-month lows out of the small cap versus mega cap ratio chart here today. Let's take a peek over here briefly on the internet. I wanted to kind of highlight a couple of things. This is the marketscholars.com website that we're looking at here, and as you can see, I've clicked on the blog heading up at the top of our website. Now remember, most of you that are premium scholars can access everything that we post in the blogs and all of our classes on the events calendar, etc., etc. But even for those of you that are not premium scholars, if you're just our free complimentary subscribers to our website, you are welcome to look at a few things out there on our blog, including the 9 at 9. Now, the 9 at 9 is something that I do in the morning that basically shows you what types of stocks are projected to be big movers within the marketplace ahead of time. So that way you can kind of position your portfolio accordingly. For instance, we saw General Mills down here as part of the 9 at 9, and it struggled. It was one of the worst stocks on the stock market here today. On the other hand, we had stocks like Union Pacific doing quite well and chugging a little bit higher along the way. In addition to the 9 at 9, you're also going to find a dividend growth investing post on a daily basis as well, as long as there are legitimate dividend increases taking place. So that's something else that you can check while you're on our website, even if you are just a complimentary subscriber to it. And remember, over here on the right-hand side, there's this area called categories. So if you wanted to select only 9 at 9 to see those, I just started posting it there, so you're not going to see a whole lot there, but going forward, you're going to see a lot of those stacked up right there. So if you want to see them day after day, go ahead. I also post that on Twitter. And then the dividend growth investing would be this one right here, where you could see most recent dividend growth investing day after day after day. So that way, even if you happen to miss a day when I posted it on Twitter, you have one kind of area of our website where you can go back and see which stocks were raising their dividends, let's say, every day for the last week or so. In addition to that, of course, you've got the market outlook, which most of you are already used to looking at here. And as a reminder, when you're doing that, for instance, let's take a look at David's from yesterday. When I load that up here on our website, remember that you can actually watch these videos on our website itself, and then we just simply ask for 3 clicks if you get value out of these daily videos. Click here if you're a subscriber to Twitter to like it. Thank you to the 92 of you that clicked like for David's post yesterday. You can also like it here and give us a thumbs up on Facebook. And then lastly, there's a little like button right down below here for our website as well. So if you could get in the habit of doing those 3 clicks, that'll go a long way for encouraging David and I to continue these free videos on a daily basis. Lastly, I wanted to kind of briefly discuss the sector selector. Remember, this is a tool where it's chopped up into 2 parts. The upper part is available for the public. The bottom portion is only available for premium subscribers. So let's just talk about the top portion for right now. Just wanted to briefly let you know that many of the rankings were the same week over the week. We still had utilities, healthcare, and industrials kind of in the top 3 rankings. We did have some slippage in the financials, a little bit of a raise out of the staples, and then we saw some movement higher in the energy, materials, and telecom space. But largely it was very similar rankings as the previous week. I will say this, however, as we kind of drift back over to paper money regarding the industrials, which remember that was the 3rd best on the board right there. As I come over here to the 12 grid, U.S. sectors 12 grid, this is chart 4G here for those of you following along at home. I wanted to point out that the industrials, which as you saw just a moment ago on my sector selector rankings, have been ranked 3rd for the last 2 weeks. And that was the one, if I briefly go back over there, I just wanted to point out, if you look at with your eyes the dark orange on that screen in front of you, what that is showing you, notice that it starts over here on June 22nd, and the industrials were ranked 9th at that time. And they were actually 9th for 4 weeks in a row before starting their upward ascent. So we've really seen some positive activity out of the industrials here for basically the last 2.5 months. And we're currently at our highest ranking at 3rd. But at this rate, I wouldn't be surprised if industrials have the power to go up to either number 1 or number 2 in the coming weeks. And the reason I say that is notice that XLI right here on chart 4G was up 0.91% today. We're now up 6.7% over the last 3 months, hitting new 3-month highs for the industrial. So very strong price activity there for that risk-on area of the market. And I kind of alluded to that earlier when I mentioned Caterpillar, I mentioned Boeing. Remember, those are the types of companies that are not only leading industrials companies, but they're also very global in nature. And they probably liked some of the news they heard regarding some of the trade tariffs here earlier today. So that was one of the leading areas of the market. We also saw that the discretionary stocks did very well today, up 1.27%. In fact, that kind of reminds me, I did notice that VF Corp was up nicely today, and those contracts do expire this weekend. I'm referring to the contracts that we traded in this video a few weeks back. We did a bull put spread on VF Corp, so some of you might look to close down that trade if you haven't done so already, now that you can get out at a profitable juncture. Other areas that have done well here today are the healthcare stocks, up 0.58. Remember, that was another one of those areas of the market that have done very, very well, up 10% over the last 3 months. One of the top performers on my sector, Selector, as well. So a lot of positive vibrations there. Really, the only concerning areas we had were the interest rate sensitive areas. Notice that we had real estate, or a lot of the REITs were down today, down 0.59 on XLRE. We had utilities down 0.18, and we had the staples down 0.42. Now, a big portion of that staples was likely because of the General Mills that I mentioned before. They came out with what was perceived to be a rough earnings announcement. So that stock was down and kind of led a lot of those consumer staples lower. Now, for those of you that are dividend growth investors, perhaps that opens up opportunities. In fact, earlier today in my dividend growth investing trading room that I teach for premium market scholars, we did have a head-to-head matchup in the consumer staples space, a couple of names that Warren Buffett has been a fan of in the past. So for those of you that have access to that recording, it has now been posted and is available for you to check out if you want to see which stock won the class vote. Let's now have a quick little chat here about the inner market analysis. And this is going to be chart 4E for those of you that are following along at home. But what I wanted to point out was that the Treasury yields burst higher here today. Now, this is something that we've been kind of looking at for the last week or so. I've been mentioning it in these presentations. What we didn't know was whether we were going to get a breakout or another fail at the same level. So when we were hanging out kind of in these candles right here, we didn't know if we were going to use this as a resistance area and bounce back down, or if it was going to burst higher. Well, today, it looked like it wanted to burst higher. Interest rates yields went higher here today. And remember, that's likely what pressured the utilities and the REITs here today, because they are quite interest rate sensitive. And when interest rates go up, they tend to struggle on a relative basis for a few different reasons. First of all, they're kind of bond proxy types of investments, but additionally, they're both heavy borrowers of debt. And so when interest rates go up, the thought process is that interest financing charges are also going to go a bit higher, and thus kind of pressure the profit margins at those types of businesses. But what I'm actually going to focus on here today for our trade application example is right here, TLT, U.S. government bonds. Remember, when interest rates go up, bond prices themselves go lower. And while you could go out and buy individual bonds if you really wanted to, the nice thing is these days with ETFs, you can actually buy a basket of bonds if you so desire. And that's what TLT represents, the long bond in the United States. Well, as I mentioned in the intro, I wanted to concentrate on a reversion to the mean type of a trade. Many of you that have been with me for years know that this is a fairly typical trade for me. We've actually reviewed nearly this identical trade several times in the past, which is when U.S. government bonds get to a point of being oversold, they actually represent kind of an interesting snapback opportunity. Now, be careful with this, because these are generally opportunities where you find that they're already in a downtrend. So this is not something where you're playing with the trend. This is a counter trend mentality. This is also something where you don't necessarily expect that we go from being in a downtrend to then being in an uptrend. This is more of a situation where you feel like in the short term, things have gone too far, too fast, and we're ready for a little bit of a short-term bounce that you can try to take advantage of through the options world, where oftentimes we focus on kind of that 20 to 60 day window. So you're not making this bold claim that all of a sudden bonds are going to go from being in a downtrend to being in an uptrend. You're basically saying right now things have gotten very extreme, and there's a decent chance that in the short term, in the next 20 to 60 days, we get some sort of a bounce out of that area. So notice that we've got this cluster setting in on TLT as of today. Remember, a 1% move lower on TLT is actually a fairly big price performance day for an entire bond proxy like TLT. So for this trade, let me come on over here now to chart 4A for those of you that are following along at home. And I'm going to type in TLT as my ticker symbol. And I wanted to kind of point out one additional thing. First of all, you'll notice that as we pull up a 3-month chart here, we had two other occurrences of what we would consider oversold cluster signals. Now, just to catch everybody up to speed, an oversold cluster signal using the market forecast indicator is where we have all three of the colored lines in the lower reversal zone on the same day. Remember, these cannot be locked in until closing prices. So sometimes you'll see these on an intraday basis, but then they'll not end that way. So they're not officially clusters until they end that way. Well, market's closed now, so this is official. We had the blue line just barely closed below 20. We had the green line firmly below 20. And we had the red line firmly below 20. And that is what creates that oversold cluster signal. You can see with this chart set up, for those of you that are premium scholars that have gone through my tutorial, you can get that set up with a nice little dot to kind of help you visualize very easily and spot when we've had those oversold cluster signals in the past. Well, in the last 3 months, we've had two additional signals there. We had a signal on this particular candle right here, where again we had all three of those lines in the lower reversal zone on the same day, and we also had it right here on this particular candle as well. Again, all of those lines in the lower reversal zone at the same day. Now you'll notice that largely the market started bottoming for TLT right around that level. Had you sold a bull put spread, let's say, with a range of 20 to 60 days on that particular candle right there, you would have done just fine, because basically a month after July 30th was August 30th, and that would have put us approximately right there, somewhere right in that range. So had you sold something on this day with a look towards the future, clearly this stock, or in this case an ETF, is higher than where we had that extreme oversold condition. And then in this particular case, it's the same thing. A month later, after August 8th, would have been September 8th, and that would have been somewhere in basically this area right here. That was a weekend exactly on the 8th, but it would have been right there. So you would have been a little bit higher there as well. And again, remember what I mentioned before. It's not that you're asking the trend itself to reverse. You're just asking the trend not to continue in the same direction with its extreme price movement as it had before giving you that oversold cluster signal. So that's kind of the bet that we would be making here today. It's not that we're going to say, yes, this is now a bullish situation and we expect this thing to be up at 124 in 3 weeks. We don't expect that. But could we realistically think in our mind, or at least have some sort of a assumption, that this is nearing some sort of a short-term bottom? Even if it doesn't change the downtrend, perhaps there's a reversion to the mean opportunity in front of us on TLT. So what we'll do is look at a bull put spread, or selling a credit spread for TLT. I've got the October contracts with 31 days until expiration. So these are your normal monthly contracts that we're looking at here. And for this, I'm going to go over here and right-click on the 116 put, and I'm going to come up here to sell, and I'm going to go to vertical. Now that loads up the 116, 115 put spread. Now notice we're selling -1, the 116, and we're buying +1, the 115. And so what that means for those of you that are newer to trading spreads is that we want TLT's price, which is currently 117.31, to stay above 116 for basically the life of the trade. Now remember, you can have it come down. Let's say it goes down to 115 in the next 2 weeks, but then bounces back above 116 for the final 2 weeks of the trade. That's fine as well. So keep that in the back of your mind. But in the end, this is a trade that you want to be slightly bullish on. Either you want that stock, or in this case the ETF, to bounce higher immediately, or simply to go sideways or even go down. Remember, this is kind of a unique trade where it's a bullish trade, but theoretically you could have this thing sell off by $1. This thing could go down to $116.31 on expiration day, but because it's above our sold strike, we would still win that trade. So those are kind of fun as well. Now, sometimes you can't get enough credit for these. You got to watch that, especially with bond ETFs. But in this particular case, you'll notice that we're going to get 27 cents out of this $1 wide spread. And as many of you are aware, we're typically looking for a 30% return on risk. So if we come over here, click on the confirm and send once, notice that we would put max profit of 27 bucks, max loss of 73. So if we divide those two into one another, take 27, divide it by 73, our return on risk is 37% there. So very easily over the 30% minimum that we're usually shooting for there. And of course, this is a higher probability trade. We have a better than coin flips chance of making money on this particular trade. So anyway, with that, let's go ahead and send that one in, and we'll see if we can get filled on that oversold situation first thing tomorrow morning. All right, well, I want to thank you for joining me here tonight. It's always a pleasure to go to work for you. As a reminder, we had a very nice kind of risk-on type of a market environment here today. There are still a few flies in the ointment there, with perhaps the NASDAQ and the Russell 2000 not doing quite as well here recently, but they're still on a rising moving average. And so I'm not giving up hope yet that they can kind of turn things back around and support this market along with the Dow Jones and the S&P 500. So today's trade application focused on an extreme oversold situation with bonds. Perhaps we get a little bit of a bounce back here in the coming weeks there. So with that, I want to wish you all the best with your trades and your investments. We'll see you on Thursday. Remember, David will be with you tomorrow, so I'll be back with you on Thursday. Until then, enjoy the rest of your day. Take care. Bye-bye.